Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right. Gotta love that
Hey,
intro.
good morning,
Tom,
Bruce. How
what's
are you doing?
happening? Couldn't
You
be
know,
better.
I'm
I'm out here on my boat, so if my connection's not perfect, please forgive me for that. But we got some things to talk about because there's a lot of chatter out there right now about these loan level pricing adjustments, isn't there?
there is. I was out to dinner with some friends last week, and that was, I don't know, half the conversation was about that. And there's a lot of myths about what is happening with that. Specifically, people think that for some reason people with bad credit are somehow going to get a better rate and an easier mortgage process than the guy with good credit, and that's not really what's happening, right?
No, that's not what's happening at all. Matter of fact, there's always been, or there has been for decades, loan level pricing adjustments. It's just a way to mitigate risk. And Fannie Mae and Freddie Mac look at ways to mitigate risk so that they can have less fallout or less defaults on their mortgages. So it's not new, and they do these pricing adjustments on a regular basis. I think the problem here again is the media, right? It just dispels all these things and gets people into a frenzy. If it leads, it bleeds, right? And so all the media is saying, oh, they're going to rob from these people with great credit and they're going to give it to the people that don't have good credit. It's not true. Now, there is some truth if you want to dissect it on a granular basis. So, if you have great credit and you're putting money down, you're still going to get better pricing than somebody that's got a 680 credit score and putting 5% down. You're still going to get better pricing on it.
Right, right.
So,
And I think that's the big thing is people think that they're not. So, um,
well,
you know,
what's happened is Fannie and Freddie are trying to stimulate the average person and give them a little bit more of a leg up than they once had. So
sure.
what they're doing is they're not they're decreasing the extra pricing adjustments that they would typically charge you for having less than perfect credit. It doesn't mean they don't exist. They're just a little bit less.
So they've lowered the cost of entry, let's say, for the person with let's say mid to poor credit, right? And made
Well,
it a little
not
bit
even
easier.
poor credit. Here's the thing, and here's the big challenge, okay? On one hand, out of this side of their mouth, they're saying, hey, the whole reason we're doing this, Tom, is so that we can help stimulate the people that really need a leg up right now. The less than 680 credit score borrower that doesn't have quite as much money to put down. We need to help them get into
Sure.
housing. So, so what they do is they have made it so that it's a little less painful in terms of your pricing adjustment. And when we say pricing adjustment in our industry, let's just say we took a 6.75% interest rate where normally they might pay 2 points to get that with a 660 score. Now they'll only pay a point and a half. Now that's an example. That's just now the
Okay.
person that had the 800 credit score. Here's the trick here. Sometimes when we run pricing, we will get better pricing if that buyer puts down 5% versus 20%. So Fannie Mae has adjusted their algorithms to say, hey, look it, we'd rather you put 5% down and have PMI than put 20% down. When we do the numbers, our risk level is less. So
Okay. So they're not necessarily helping people with poor credit. They're helping people with mid credit, right? Mid level, like
that's
okay
right.
credit.
That's right.
And so at the same time, because the other thing that I heard, again, I know this is noise and chatter, but that this adjustment is going to potentially make it so that they're writing more poor quality loans, lower level loans, and we're going to have another 2008 crash because we're writing bad mortgages.
You
That's not
know,
happening, right?
it's so funny that people are saying that. It's just not true whatsoever. Matter of fact, on the same at the same time where they've made it more attractive for that mid-level borrower to get in, they tightened up the restrictions on the guidelines and made it harder for them to get in.
Okay.
So on one hand, we're going to give you better pricing, but only if you really qualify, because we're making it a little bit more challenging for you to qualify. So
Okay. I
it,
kind of like that.
well,
I,
I don't know if I like it because it's giving on this hand and it's taking away on that hand. But generally, when you see the government come out and say, "Hey, we're going to make it better for you," look the other direction because there's a catch, okay? Something's not right here. And
well,
it's not.
what's the famous words of Ronald Reagan? Right. The most dangerous words in the English language are "I'm from the government and I'm here to help." Right.
That's right. That's
Yeah.
right. So, yeah, so whatever, but here's the thing. If it's still a great time to buy, if you got great credit, you're going to get better terms than somebody with a 680 credit score below. You're not getting penalized. You're just not getting as much of a benefit, and the person at the lower scores are getting a slightly better benefit. However, the prudent underwriting is still there. So they've tightened it up a little bit to say,
Got
we'll
it.
give you better pricing, but by God, you better qualify. So
Right. Okay. Well, so yeah, I mean, when I say I like that, I don't necessarily like that from the. I think that's going to lower the number of loans and sales that happen, but at the same time, long term, I think that's keeps our underpinnings of our financing good, so we don't end up with a lot of defaults.
well, we
Having a lot
can't.
of
We
defaults
don't
is
want to
bad.
go from the pot into the fire here. And right now, we've had prudent underwriting since 2010 during
Yeah.
the reform, and I don't see any reason why that should change at all. Right now, defaults aren't that there's just not a lot of defaults.
There's very few.
I mean, I don't know what your numbers are, but if you look up how many foreclosures were in the Central Florida market, it's probably like between 3 and 5. That's
Well,
it.
I do have some friends that are in the foreclosure business, and what their attorneys and such, and what they're seeing is that all these banks are recasting the loans.
Of course they are.
They're
They don't want to
breaking
own
them.
your property.
No, they're just they're doing everything. I think that's one of the good things that came out of the 2008 crash is that they figured out how to do that effectively and at scale.
Right.
And I think it's going to prevent a lot of big, future big problems that could happen.
Well, here's
So
one thing I can tell the listening audience out there. If you have flexibility with your down payment, you might find that you're going to get a little bit better terms by putting less money down and paying private mortgage insurance than putting more money down and not paying private mortgage insurance. Now,
sure.
when you call me, we'll weigh it out to say, hey, look at here's your payment at a little better terms with PMI versus a payment with no PMI, and then you can make a determination as to which one is best for you. That's
Got
the real story.
Fantastic.
All
That's
right.
awesome, man. Hey, listen, you know what? I am seeing, I got to tell you right now, you mentioned it's a good time to buy. The summer is heating up, right? So here we are, we're at the beginning of May, right?
Spring fever, baby.
And all of a sudden, inventory is getting lower, right? There are still less sales than there were, but there's also a whole lot less listings, and the good listings are going super quick,
Yeah.
super, super quick.
Yeah.
So
They are multiple offers again. It's not 20, but I'm seeing four,
it's not.
five, 6 offers on a
Yep.
property at any given day.
Yeah,
Yeah.
every listing that I put up, if it's priced right, I get multiple offers, two or three, and my seller has choices, right? So, and when they have choices, we always look for the most likely to close loan, right?
Yeah. Of
And the most
course.
likely to close loan is the one that is strong, right? Um, and when I talk to the lender is super confident
So
that
it's
they're going
interesting
to
you say that. I am going to be teaching a class this Thursday at 11 o'clock. You can go to webringyouhome.com. And this class is all about how you can save your commission. Because do you know that 60% of people that are buying a home, getting a mortgage, and using a real estate agent are dissatisfied with the process? Did you know that 2 in 10 people that buy a home don't close on the closing date? And 1 in 10 don't close at all. Now, these are people that have a pre-approval letter. So if you're a real estate agent out there, I'm going to show you and I'm going to give you scripting and checklists on how you can determine how much of a big fat liar that loan officer is that wrote the pre-approval letter. So that's at
That is
11
awesome.
o'clock Eastern Standard Time. Go to webringyouhome.com. I'll give you all the tools you need. You'll save yourself so much money and aggravation. It's unbelievable. I got
I'm
to
gonna go
jump out.
register. I'm gonna go register for that right now, man. Hey, listen, I gotta go. You have yourself a fantastic week, and I'm
Yep.
sure I'll talk to you soon.
Do the same. Thanks, guys.
All right, bye.